So, did everybody do their reading? Ice down? Didn't waste that spring break time at all on the awesome price discrimination chapter? Okay, so what are we doing? We snap right back into things here, talking about monopoly and prices. So, I want to start off today just kind of refreshing basically Chapter 9. Make sure we're crystal clear because we're going to be really utilizing the areas of consumer and producer surplus as we get into these detailed pricing strategies. And so you have to be crystal clear on the basic monopoly setup from Chapter 9 where we have a single price monopoly. What that means is that for every additional unit they want to sell, they have to lower the price, not only for the extra unit, but for all the previous units. That gave us the downward sloping marginal revenue curve that's twice as steep as the demand curve. Now, as you've seen, if you'd gone through Chapter 10, and I think we did it a little bit in Chapter 9, we made a simplifying assumption of constant marginal cost. That just kind of helps out a little bit. We could do an upward sloping one. But many times we'll just, for simplification, we'll put the marginal cost being constant at some amount. All firms maximize profits by producing the quantity where the revenue generated by the last unit is equal to the cost of the last unit. Gives us the profit maximizing quantity. The monopolist charges the highest price people are willing and able to pay for that good. And there's the classic monopoly model. All right, so the basic idea of price discrimination is to try to extract some of the consumer surplus and change it into producer surplus. As this model stands right here, Area A represents consumer surplus, the difference between what a consumer is willing to pay and what they actually pay for each unit that they consume. And so that represents our consumer's surplus, our consumer's benefit of this market exchange between the monopolist and themselves. Area B represents the producer's surplus, the difference between what the producer actually gets, which is PM, and the minimum amount they must get for every additional unit that they sell. And so that represents this rectangular region B. All right, so the whole objective of Chapter 10 now is coming up with some clever ways to see if we can get, we being the producer now, since we have our producer hat on, can we extract some parts of Area A and make them Area B. So we're trying to capture some of the consumer's surplus. The consumer's more than willing to pay more for those units. We just have to be a little more clever on how we get that. So there's some conditions that need to hold in order to do that. And so I got the projector here queued up. There's a nice figure in your textbook that kind of goes through all of the pricing options, and there's a lot of them. This is definitely new material compared to your principles text. Likely, at least the principles text, the version that I do, we do third degree segmenting. This is the price discrimination that we talked about in there. But here we've got all different types of ways of attempting to gather some of that consumer surplus. So starting at the top, one of the conditions that you have to have is market power. So in principles class, we had 3 conditions for price discrimination. These are kind of the 3 big ones that would allow you to ultimately perfectly price discriminate if you had enough information, and then that brings us into all these cases. But the first step is, do you have market power? Now, what does that mean from a graphical standpoint? When we say market power, what does that mean for the firm? the demand is downward sloping, right? So the firm faces a downward sloping demand curve is what market power means. You have some pricing power. So that could mean it's very flat, very elastic. It could be that it's very steep. It doesn't necessarily imply that you have a monopoly, that you're the only firm, but you have market power. So it could be monopolistic competition or oligopoly, but you have some sort of market power there. And so the demand curve could look like any of those, but as long as it's downward sloping, remember that it's perfect competition that has the perfectly elastic demand curve, and that's not the case we're talking about here. So that's market power. So it says if you don't have market power, you're in a perfectly competitive situation. You're a price taker, deal with it. Marginal revenue equals price. Can the firm prevent resale or arbitrage? So that's condition number 2, no resale or very prohibited resale, or it's very hard to resell. The gist of it here is that if there's resale opportunities, somebody else is going to make money off of you. They're going to be the low buyer and just resell it to somebody else and make a profit through arbitrage, buying in one market, selling to another. And that's exactly what you're trying to do. So you can't have resale opportunities. So if you don't have, if you can't prevent resale, then you're back to the monopoly situation, and you just have the single price monopoly. So with no resale, so if resale, then let's just call it the normal monopoly situation, the case that I just went through. You still have market power, you're still going to be able to restrict quantity, you're still going to earn economic profits in the long run. You know, all of that stays in place. Your market power is still going to be good for you, but you're not going to be able to price discriminate. All right, and then the last one is where you can get into a bunch of different variations. So do the consumers have different demand curves? And really it's going to come down to differing demand elasticities of consumers. And that brings us into a number of different cases. So the one we did in principles class, where I used the example of a movie theater, and we have student discounts, right? So you can't resell it. Students are, let's say, a lot poorer than the non-student on average. The demographic is different. We're able to separate students and non-students through the use of an active student ID. So we have all the ingredients there to do some segmenting. Charge the students a lower price, charge non-students a higher price. So that was due to differing demands and being able to separate out those folks. So that was third-degree price discrimination. All these other cases then involve situations where we might not be able to do that perfectly. So if the firms have customers that don't have different demand curves, in other words, the customers are identical, you still might be able to do some stuff. So these are covered at the end of the chapter, block pricing and two-part tariff. So what that means, so if we have kind of case number 1 here, what did we, advanced price, well this is 10.6. I'll just call it case number 1, identical consumers. The neat thing that this one plays off of is to say, okay, there's Tom, Dick, and Harry. You know, we have 1,000 consumers and they're all identical. It's kind of an extreme case, but let's just say that they're all basically the same demand curve. Your market demand curve is going to be one thing. Is there a way to extract a little more surplus off of that situation? So the idea here is that one consumer could be at point A, where they're willing to pay $30 for something at 100 units. But we know from the downward sloping demand curve and our market power that there's other people out there that are willing to pay 15 as long as they get more units. So one consumer could stay out here, one consumer could be out here. All we're trying to do is see if we can get shifted out further to again extract some surplus. So imagine if, I won't do all the details, your textbook does a good job of that, but imagine that if the profit maximizing quantity was 100 under the traditional monopoly situation, then area A would be right here. And our surplus area would be here. All we're trying to do now is move into this area of the demand curve. If we can somehow get these extra units sold and the marginal cost is constant, I guess I will go ahead and throw in a marginal cost curve just for fun. Can we get into this region? As long as marginal revenue is above marginal cost, we're okay. So if we can sell those units a little bit higher, we can start to chunk that off. And so if we're able to sell the extra units, these extra 30 units at this price, let's call it $23. So buy 100 units, but then the next 30 units you can buy for $23. That's a good deal because the firm picks up this extra area because the marginal cost of those extra 30 are right here. That's the total cost would be this rectangle minus the total revenue gives us this additional profit, producer surplus off of those marginal units. So that's this block pricing strategy.
It sounds like it's just a bit more simpler and more discrete than quantity discounts version.
Yeah, and I'll talk about that in a little bit. This one's very close to quantity discounts, but it is different because we're playing with the same demand curve on how you approach the problem. It's a little bit different. Okay, anything else on that one? So if we have consumers with different demand curves, we run into a couple different cases. One, if we can't identify them or if we can identify them. So if we can identify the groups, that would be the student ID type. Like we know we can legally separate out the groups, so you might not be able to do it by gender or by race or by religion or protected classes, but if there's a legal way to get the people into those groups, then you can do the third degree or perfect. And we know that perfect's kind of an extreme case that's pretty difficult, but probably can come maybe close to that if you're under a pure negotiation standpoint. If you can't identify them, then we have to go into indirect price discrimination. So here we gotta be almost extra clever. We have to figure out a way to sort people into the right places all by themselves. So we're gonna go through some problems on this one. This one's probably a little bit more difficult one to handle. And one of the topics that we'll discuss is whether it's your scheme, your pricing scheme is incentive compatible. So if we have kind of high demand customers and low demand customers, we don't want to get in a situation where it's better off for even the high demand customers to just do the bulk deal, given their demand curves difference. And that's where going into a problem will be helpful. Okay, questions or comments on that? I think once you go through this chapter, and if you really understand the economics of consumer surplus, you'll start to see this going on all over the place, right? This is not new. This is sophisticated pricing that we're used to seeing out in the marketplace, and these are the reasons why that we see them that way. Okay, so let's start off with that problem I gave you last time. The mega data, we did not do that one, correct? So let's take a look at that one. I don't think I do, but you'll be able to, I'll put it on the overhead. And you can just jot down the guts of it. This is the Mega Dat.
It's on the back of this.
Yeah, it was on the back side. It's this one. Mega Dat. So software deal. If you don't have it, just grab out notebook paper and you can jot down some of the details here. So you're a new software program. You have two types of clients. Type A with that demand curve, and type B with a different demand curve. Assume that your firm faces a constant marginal cost, $20 per user to install the software. If you can tell which type of buyer is buying the product before a purchase is made, what prices will you charge each type? So that's kind of the traditional segmenting, if you can tell. Now this goes on all the time with software. You guys have maybe seen this in some of this stuff. So if you've got the Adobe Reader, or if you get into some CAD software, they'll give you kind of a free version or a real cheap version, and then they'll say for only $20 more you can get the unlimited version. This happens all the time with software. Now think about it. Is there really any cost for them to unlock the key to the upper version? It's all there, right? All the coding, everything's right there at your laptop, and you hit that little install button and boom. It's cost free for them to give that to you, but of course they're holding it back purely for this setup. They suck you in with the free version, you like it, you get to try it kind of for free, and you start to sample it, and then to get the enhanced thing, if you need it, then you do it that way. And so for business purchasers, this kind of goes across the board for software programs. For businesses, they might not care about pricing. They're just like, hey, I'm doing a business, this looks awesome, this will be very profitable for me. $100, $200, $400, whatever it costs, right? They're very inelastic demand. So how do we get those, sort out the business customers versus the student who's doing a class project that would be cool to use the software program to build a little model, but they're not going to go much beyond that. So that student might be willing to pay the $5 entry fee, or maybe it's free, and they'll use it, and then maybe later on in life they'll come back for the enhanced version. So that type of stuff is used all the time. So let's work through this problem and see what we get. Should be, how are we approaching this first part A? Make sure we're all on the same page. Tell me in words how you approach it. Graph it, okay? What are you doing conceptually then if you're using equations or graphs for each type of consumer here? So if you could tell which type of consumer is buying the product, what prices will you charge each type?
You can charge type A where marginal cost equals marginal revenue, and then you're going to charge type B where marginal cost equals.
Good. So you just treat each one individually, yes?
Do you end up putting it into the demand curve to find the price?
Yes. Yep. And then you'll substitute. So you'll solve for the quantity, marginal revenue equals marginal cost for each type individually. That'll charge you and then substitute that back into the inverse demand curve to find the price. And you'll be charging a different price to each group. So this could be kind of the student ID versus non-student type situation. You can identify the groups. Everybody agree with this? What did we do, Brenson? Double the slope. That's all you do for marginal revenue for Group A.
Wasn't he half this?
Double. So marginal revenue is twice. So when you're thinking about that one, draw a quick little graph to remind yourself. So if you got demand, marginal revenue, this one's 2 times steeper, twice the slope. What'd you guys get for B? For quantity. 10 for B.
For the marginal cost, because it says per user.
For which one?
Says the firm faces a constant marginal cost of $20 per user to install into the software.
So yeah, so per user per unit. So we're kind of thinking that on a per unit basis.
So it just still be, it wouldn't be 20.
So it'd be just 20. Just constant at 20. And I think we'll pretty much use that constant assumption through most of the chapter. All right, everybody get both A and B. I didn't write down the guts of B, but work through B and A. How you doing?
I was wrapping.
Oh, okay. Why don't you jump into the equations? We will do the graph, so that'll pay off. All right, so when we substitute this back into the demand curve, and how much are we charging the A group? 70. Charge this back into the B group. And how much are we going to charge them? How much? 40. All right, so everybody okay with this? So part B, Branson, you okay?
Yeah.
I want everybody up to speed. You have to be up to speed to this. Otherwise, the rest of the chapter is futile. Okay? So, part B. Suppose that instead you cannot tell which type of buyer the client is until after the purchase. Suggest a possible way to use quantity discounts to have the buyers self-select into the pricing scheme and set them up. So what do you think there? So charge 70 for what? Okay.
And 40 for quantities greater than 5 and less than 10.
And less than 10. All right, now we'll just leave it greater than 5. So, all right. So where would that leave us? Let's graph out. Why do you say that, Michael?
Because if they're type B, they're already consuming more.
So those of you who started, so type B is consuming more, so let's try to keep the people that are where they're at, right? Because we know we maximize profits there. And I guess I can just kind of borrow this. You guys were graphing it out a little bit closer. So we had, what was it, 70 up here. This was what, 120 was our intercept. Marginal cost was what, 20? Okay. So there's kind of our type A person, given our setup we just solved for. And so our type B person would look a little different, but what you're trying to do is do the 40, right? As kind of the breaking point. What if we offered 40 out, but they have to buy that quantity to get the $40 deal? So we want to come back to this person and say, well, of course they would like 42, right? Are they going to do it or are they not going to do it, given their preferences? So at a price of 40, how much is this person willing to buy? How much is that person willing to buy? 8. How'd you get that, Brinson?
Plug it into demand.
Plug it into the inverse demand curve, right? So we know this person's demand curve is, let me write it out over here. Price equals 120 minus NQ, right? And so at a price of 40, shoving it into here, solve for Q, you ended up getting 8. So if we shove that in, graphically, we end up at 8. And here was our 5. So the idea is this person would still be buying some. They're not going away. They have a demand. They have a taste for this product at a price of 40. So can we do what Michael's got suggested here of greater than 5? No. Why? That's right, that won't work. Because they would definitely do it. There's no problem with that. So we got to fix this part. We got to fix this part. Does this need to be, the concept's still there, I think. But yeah, 8 seems to be our break point, right? So if we know that our other consumer down here is optimal at 10. So our pricing scheme could be you have to buy at least 10 or more. So as long as you buy a quantity of greater than or equal to 10, let's just try that out. So at a price of 40, it's possible that it could still be beneficial for this person to be in that deal. So how much surplus is there at 10 units would be the question. What price is this person willing to pay for 10? 20. Okay. So the price is going to be 40, not 20. So at a quantity of 10, our break point here, would this person still buy the deal? How would you know? So at a price of 10, is this person getting any consumer surplus off of the 10th unit? No. But would they still possibly jump into the deal compared to paying 70 with 5? They're willing to buy 8 at 40. Chelsea.
Depend on how much like that negative consumer surplus costs.
Right. So now we're doing a balancing act. So let's recap here real quick. The consumer is happy as a lark up here buying 5 units at a price of 70, earning consumer surplus A. If the deal was such that it was at 8, they would also jump into the market and they would pick up this little area, right? So they would get a little bit additional off those units, plus they would pick up their new consumer surplus area would be this whole big triangle there. And then furthermore, it's possible that they would even go further and just throw those extra 2 in the garbage can if they didn't need them because of their total expenditure that they got. So at 10, paying a price of 40, we've got some negative consumer surplus. They're only willing to, oops, let's see, I butchered this a little bit. This is at 20. This is at 10. If you guys, those of you who drew this a little more carefully, this should all work out. So at 10, they were willing to pay $20, but they didn't. They paid 40 according to the scheme. And as Chelsea pointed out, they lost some area here. So this is negative consumer surplus. It's kind of a loss. But at the same time, they will have gained some other area off of those extra units. So what area did they gain? They picked up these units. They had a bonus because they were willing to pay more. They picked up this little area. They picked up this little area, but they lost this area. They paid 40. Some of it they bit the bullet on, some of it they gained. So we've got this competition now of what this area compares to this area. And so that's the last thing on incentive compatibility. We don't want these people to be jumping into the quantity discount. Otherwise, we're, again, kind of unraveling our scheme of having them self-select into it because incentives matter. And if the incentives are such that they would rather buy the quantity, then the producer's going to lose out because all of them are going to jump into that quantity, and they won't capture that consumer surplus. Okay, so now you got to get your calculators and geometry out. We've got all the pieces of the puzzle. Is this incentive compatible for this pricing scheme now? We're not doing this one. We want to check out if this is incentive compatible. So you need to calculate those areas.
By incentive compatible, what is that?
We know that there's 2 groups,
Yeah.
and by creating 2 different segments of the market, will they self-select or not, or will all of them end up going with the big discount? So what we're checking for is if this area here is bigger than this area, So don't go by my geometry here.
Are
You need to calculate some
including
numbers.
A or just the
So
orange?
pretty much you're saying,
You got to compare orange versus green.
Okay, so you don't include the A. in that
Right,
one, okay.
because that one's there. We're just looking at the margin of this
Is it-
change.
by asking really, is it incentive compatible? Are they, for type A, person A or whatever, they would be incentive compatible if they're paying less for 10 than if they were paying the original amount of 5?
The benefit, you got to be careful on the pain because it's actually the benefit to them because we're measuring consumer surplus. So if the benefit to them of biting the bullet, buying the quantity, and then throwing in the garbage can the extra 2, if that's a better deal for them, then it's not incentive compatible. So calculate these areas. So we're going to take the orange area versus the green area.
So would you try and solve the black or like as far
No,
as you get?
no, you're just calculating purely the areas. So if this consumer takes the deal, they're going to buy 10 units. But they're actually going to lose consumer surplus on these extra 2, and they're going to gain some surplus on these extra 3, plus a lower price on the rest of them. So there's a couple little calculations here. You got a rectangle plus the triangle. Who's got an area?
195 for orange.
195 for orange. Sounds good. And 20 for green. So, is this person going to buy the 10? Yeah. So it's not incentive compatible. So this deal will not go the direction we want it to. Which means we might have to either change or scrap it or whatever. But we want to keep the people in their groups. And this one, these people are going to say, oh yeah, that's a great deal, I'll do it. So therefore, not incentive compatible. Type A will take the type B deal. And that's what we don't want to have happen. So it's not incentive compatible. Now, what happens as elasticities changes? What happens to these areas if we were to start to flatten or shrink this? Yeah. So as we start to change things around, those answers could change, and so that's a lot of this deals with the elasticity of demand. Okay, so that gives us a little taste for that, and that's using the quantity discount. So let's do another one.
So the
Yeah.
green, I'll make sure green area is greater than orange area,
Then it's incentive compatible, and then this person will stick with buying the fewer units at the $70 if it was flipped around. And your tonight, if you guys want to review this again, your textbook goes over another example where it is incentive compatible in your text. So you might want to check that out. So this time, let's look at a health fitness club, weight machines, and a swimming pool. What's so funny?
Camera's on me.
Oh, it always kind of sticks on you, doesn't it? I think it likes you. All right, so again, this one's probably a situation that looks kind of familiar to you.
What I don't know is steady worker is not another fit clothing, so it's not right. Oh.
All right, so we got some bundling going on. Now, on our first look, when I moved to Ottawa, I ran into an issue like this. I might have even mentioned it to you, I can't remember. With the old internet deal. What does the cable company tend to do with their deal? What can you get with when you go to get cable? What's some other things that you might be able to get? Phone and internet, right? So you got cable, the normal get my 60 channel package or whatever, which has some bundling in it of itself, and your textbook goes through some of the examples there. But now we have cable, internet, and phone all looking to be potential purchases. And so I really just wanted high-speed internet when I called up. I didn't want cable. I didn't want local phone. I had my cell phone, right? So you've maybe seen the flyers in the mail, $30 for this or $40 for this, or a bundle of all three for the low price of this, you know. So what's this bundling all about, and how does it work? So that's where this problem takes us, is to start thinking about the individual consumers who are there. So in my example, I had a fairly high willingness to pay for high-speed internet, but I didn't want cable and I didn't want the phone. But at the right price at the margin, maybe it would suck me into it. So I think the standalone internet was, and I can't remember the numbers exactly, but I think it was, let's say, $40 or $50. And the bundled package was $65. So it's $50 if you just want internet, but if you want everything all bundled together, it'd only be $75. So what would suck me into that, right? I didn't really want phone, but if it's free or close to free, I guess having an extra line's not going to hurt me. Maybe I'll use it once in a while, right? So my demand curve for the phone service, if we were to think about what that looked like, might have been very low and flat. So there's my phone, here's my internet, which was the most inelastic. So here's internet for Russ, here's phone for Russ, and cable's probably somewhere in between here. I wouldn't mind having a little ESPN action and stuff compared to just doing all internet-based television enjoyment. So what's the deal? Can we bundle these together? So by offering a bundle which is fairly cost-free to the cable company, again, to flip a switch so that Russ has all three instead of just one, right? I mean, it's all coming over the same doggone line. There's basically no cost to it. They can induce me to possibly buy the whole package if my willingness to pay for the extra two summed together was 15 bucks or more. If I got $20 worth of enjoyment, then I would buy it for sure, because I'd get my internet enjoyment of 50 plus 20 is 70. I'd have $5 worth of consumer surplus if they were charging me 65 for the bundle, right? So they've got these schemes like that that could possibly extract an extra 15 bucks from me compared to just offering them individually. So that's what this this problem looks at. We've got a health club, 2 types of equipment, weight machines and swimming pool, 3 customers, Abe, Betty, and Chris, and the willingness to pay for each equipment is listed below. So here's the willingness to pay part for each individual for the weights, and here's the pool willingness to pay. So who's the swimmer here? Chris is apparently the swimmer, and who's the weight machine person? Abe. Now therein lies one of the ways that you can find it advantageous to do some bundling, is when their preferences are such that they're crossed, they're mixed. There's a negative correlation between their preferences. We have a high consumer here, and we've got a high consumer here. They're different. We don't have identical demands, right? So that sets the stage then for moving on into some bundling options. We'll pick up there next time.